if you're looking to minimize tax and social charges and maximize your income, which sounds like the holy grail of all business structures, then maybe the SASU is for you. Hello and welcome back to this channel where, as usual, we do not offer or perform any accounting services. Simply, we explain to you how things work so that when you see your accountant, you have a better idea of what you want and why you want it. A SASU is a single person SAS. The U stands for unipersonnel, and we'll get to the dividends in a couple of minutes. Now, let's not imagine that the SASU is going to suit everybody. It very much depends on your personal situation, and as usual, there are advantages and disadvantages. It is easy to set up and it covers a wide range of activities. There's no limitations there with commercial people can, but artisanal people can't. You can do whatever you want with the SASU. It's very flexible. So if at any point down the line you decide you want to transform your SASU into something else, then you can do that and it's not difficult at all. It's subject to company tax by default, although there is an option for income tax if that will suit you better. But being subject to company tax by default means that you can decide how much you want to pay yourself, and obviously that's going to have an impact on how much you pay in social charges. If you don't pay yourself anything, then you won't pay anything in social charges. And bear in mind, if you don't pay any social charges, then you also don't have any social protection, and we'll come back to that in a minute. And yes, there are unlimited dividends, provided that you have declared at least one bilan, that you've shown a profit, and also provided that you have paid your company tax first. You can't say, I'm taking dividends and the amount of dividends that I'm taking is going to reduce my company tax. You pay your company tax first and you take your dividends afterwards. Now, that's not the last word on dividends, and I'll come back to them again in a minute or two. But let's look at the disadvantages, and actually I can only think of one, and it's the cost of social charges, which sounds like I'm contradicting myself because I did say we were going to reduce social charges. As the president of a SASU, you are a salaried employee of your own company, so you actually have a pay slip. Unlike any of the other self-employed statuses, as an entreprise individuelle, you don't have a pay slip. As the gérant majoritaire of an SARL, you don't, and if you are the gérant of an EURL, then you don't either, but as the president of a SASU, you do. And what that means, briefly, is that for every 100 euros that you have will cost your SASU 175 euros approximately, which is a high price tag, I know. But having said that, you do also get an exceptionally high level of social protection. Importantly, social charges are only payable on the salary that you pay yourself, which doesn't have to be all of your profit. It could be only a small part of your profit. And that leaves you to withdraw the rest in dividends if that's what you want to do. Bearing in mind that withdrawing everything as dividends may not be the best idea. You may be better off with a company savings plan, for example, which I talked about in this video, and I'll link it at the end. But then why pay yourself any salary? Why not just take it all as dividends? And the reason is because there are some conditions attached to taking dividends. As we mentioned before, you need to have declared at least one bilan, so one end of year account. You need to have had a positive result. It seems that I've written this a bit in franglais, but you need to have declared a profit and you need to have already paid your company tax. But if you need to get to the end of the year before you can potentially take any dividends, then you need to have some money to live off. Now, do you have that money? This is a perfect solution if you are receiving the ARE, which is the Aide Retour à l'Emploi, or the ARCE, not the ARS, but the Aide for the Reprise ou Création d'Emploi, because what you can do is you can carry on receiving these benefits. You can leave any profit in your SASU, use these as your living wage until you reach the end of the duration for receiving them, and then only at that point start drawing money from your SASU. And this is perfectly legal. Pôle emploi are completely used to it. They will even advise you on how to do it. And if at the end of the duration of your benefits, you want to then come back to a different structure. That, as I said before, is entirely possible because the SASU is so flexible. As we mentioned before, if you pay no social charges, then you will also have no social protection. Now, this may not be a big deal for you. If you have entirely private arrangements for your pension, for your healthcare, and you know that you're never going to require anything at all from the French state, then this may not be a big deal for you. But if that's not your situation, then you would be better off just paying yourself a small salary, just enough to cover your quarterly pension contributions and to have the time counted towards your pension, and at least you'll know that you're covered. Third good reason to pay yourself a salary is if you take everything as dividends, then you leave yourself open for the Puma tax. And no, it's not this kind of Puma, it's the Protection Universelle Maladie. There's the A, Puma. And what it is basically is it's a rap on the knuckles if you take everything as dividends and you don't have any other income coming into your household, then the state will see that as avoiding social charges. In 2023, if you pay yourself above 21,996 euros in dividends and you have less than 8,798 euros coming in other household revenue, Puma will be levied at 6.5% on everything above this 22,000 euros. And if you think about it, then that's not actually massively punitive. That might be a penalty that you are prepared to pay. And your decision will depend very much on your personal income tax liability. So only you know if it's worth it to you to do that or not. But if you do want to avoid it, then you might want to take a small salary. But if you do have a spouse or a partner who is declaring more than this amount of money, then that leaves you open to theoretically taking everything you want in dividends. There's no problem at all. But here's another good reason not to do that, and it's tax. So remember that your dividends are taken after you've paid your company tax. And remember the rates of company tax are 15% up to 42,500 euros and 25% after 42,500 euros. So paying yourself a small salary could be the difference in company tax at 25% or in paying company tax at 15%. So here I'm going to imagine that you did not take a salary. You had a profit of 80,000 euros, of which the first 42.5 will be charged at 15%, so 6,375, and then the next 37.5 between 42.5 and 80 will be charged at 25%, so 9,375, leaving you with a total company tax bill of 15,750 euros. And then you do have 64,250 that you can withdraw as dividends. That's true. But if I do take a salary, imagine I take a salary of 30,000 euros, then social charges on 30,000 euros would be approximately 22,500, leaving me with 27,500, which will only be charged at 15%. So my total company tax bill is 4,125 euros. So that's a saving of about 11,000 euros there in company tax, and it leaves me with this much left over that I can take in dividends. And you'll say, well, that's fine, that's nice, but I have paid 22,500 in social charges, so you need to find me a few more savings than that, right? Precisely 10,875, because here I've got this 23,375 plus the 30, don't forget the 30. But here I had 64,250, so I still need to find more in savings for this salary to be a better idea. Can I find them? Well, potentially I can. Let's see if I can. Let's not forget that our dividends are also subject to income tax. And dividends can be taxed in two different ways, and this is the first way. It's a flat tax at 30%. So you pay 30% on the totality of your dividends, and if you had the 64,250, then that would equal nearly 20,000 euros, leaving in tax, but still leaving you with nearly 45,000 euros. And if you had the dividends at 23 and a bit thousand, then you would be paying 7,000 in income tax, leaving you with just over 16,000 in your pocket. Plus your salary. Remember your salary, which is also subject to income tax, but probably not very much. If you're a single person, you'll pay something on that, but if you're a couple, then it's going to be peanuts, and if you have any children, then it won't be anything at all. So that would leave you with 46,362, whereas here I've got 44,975 plus whatever will be net of income tax from the second salary coming into the household. So that's looking a bit close, because here as well, potentially there's a second salary coming into the household, let's not forget. And what you need to do is just do a few simulations so that you can see in your own personal situation which one is going to be the most advantageous for you. What you don't want to do is end up in a higher tax bracket. And remember that these are the tax brackets, so especially between here and here, 11 and 30, or here and here, 30 and 41, you don't want to find that just taking that extra amount in dividends is going to push you up a whole new tax bracket. It's worth taking the time to juggle the figures a little bit and just being very sure that you've got the right solution for you and your personal household and your personal situation. I did say there were two ways of taxing dividends, and this is the second way that I won't spend too much time on here, but if you want to come back and look at it, you're more than welcome. What you do is you would pay 17%, which equals the CSG and CRDS, on the totality of the amount you take. So that would be that, in that case, nearly 11,000, and that would be nearly 4,000, leaving you with this. And then this would be declared as income, and you would be charged income tax in your personal tax bracket on 60% of this amount. So in this case, that would be 60% of this amount, and in this case, that would be 60% of this amount. So here you would have 21,331 euros in your pocket, because that's the difference between that, and then net of what's left over here plus the net of the second salary. And here, well, you can follow the figures through, and I think you'll understand how that works. So yes, you do need to juggle the figures a little bit, but now you have the mechanics of how this works, then you can take the time and work out if SASU might be an option for you or not. I hope that's answered some of your SASU questions. I've linked another video or two up here for you. If you haven't subscribed yet, then don't forget to do that, and I'll see you again soon.